Welcome back. In our last video, we talked about the cash payouts known as dividends. But remember that phrase we hear all the time? Capital gains and dividends? Today, it's time to tackle the first part, the capital gain. Let's go back to our pizza shop. Suppose the owners decide not to pay you a dividend. Instead, they keep that profit to buy a new delivery truck and open a second location. Why does this help you? Think of it this way. The business now owns more physical stuff, like that new truck. Plus, with a second location, they can sell way more pizzas next year than they did this year. A business that owns more assets and makes more money is simply worth a higher price tag. Because the business is bigger and stronger, other people now want a piece of it, knowing that as the business expands, their investment will grow right along with it. If you sell your share, you might get $1,500 for the share you originally bought for $1,000. That $500 profit, that is your capital gain. But here is the big question. How does a small private pizza shop actually become a massive stock that you can buy on your phone? It happens through a major event called an IPO. Join me in the next video to find out why companies go public.